Good afternoon, ladies and gentlemen. My name is Michalis. I'm one of the market analysts here at HF Markets, and I'd like to welcome everybody to the second webinar of this week. Now, in today's webinar, we're going to be looking at two trading methodologies. We're going to be looking at swing trading. A lot of traders asked us for some information about swing trading. We provided that. We had a specific webinar where we solely looked at swing trading. A lot of people asked us about day trading as well. We did a couple of weeks ago a webinar which we spent 45 minutes only speaking about day trading. So today what we're going to do is we're going to look at which of the two may be the right one for you. So which is more beneficial? Now, a lot of the time, traders ask questions. You know, they say, what is the best strategy? What is the best trading methodology? What is the best asset that I should be trading? Now, some assets, some questions, there is a yes and no answer. For example, yesterday's webinar, we were looking at live analysis. We were looking at signals. We looked at, for example, signals for the NASDAQ. We looked at the Australian dollar against the US dollar. We looked a lot at the euro. And there was a lot of scenarios where, yes, it was either a buy signal or a sell signal. There wasn't something in between. But sometimes it does depend. And today we're going to explain exactly why somebody, depending on their characteristics, their experience, what asset they're trading, when they are trading, what they're trying to achieve, depending on multiple factors, whether it is more beneficial for these individuals to be looking at day trading, or if it's more beneficial to instead be looking at swing trading. So this is what we're going to be doing as part of today's webinar. And of course, just so everybody's aware, we will definitely be looking at strategies for both. We will have a swing trading strategy and we will have a day trading strategy. And we will explain what the benefits and disadvantages is for both. Now, before we start looking at that, just very, very quickly, I want to go through two slides, which is a very quick introduction. Now, people know me very well because I've been in the market now for 10 years. Yes, I'm a financial advisor, but these webinars here are not they're not here with the purpose of giving you financial advice. So they're here for educational purposes only. Everybody should be aware of that. Also, another thing that everybody should be aware of is that when we're looking at trading CFDs, it is an investment. It's not a savings account, it's not a bank account, it's not investing in things like bonds and ultra low risk investments. It is an investment and we have no control over how the price is going to move. So you have to, of course, understand that there's a risk to the capital that you are investing. But this is, of course, also why webinars are so important, because webinars will confirm to you how you can potentially increase your success rate, how you can control risk, how to create strategies, how to create a trading plan, and so on and so forth. Now, as part of this slide, I don't want to spend too much time on it. Very quickly, just so for the new people that have never seen one of my webinars or one of my seminars, or had a one-on-one session with me. My name is Michalis. I'm a market analyst here at HF Markets. I've been a financial advisor for 4 years. That was in London. I hold 2 licenses. I hold a UK-based license. I also hold an EU-based license. If you go on the CISEX website, the regulator's website, basically, you can see I'm on the list there of approved individuals. Also, a bit about myself. Overall, I've been in the market for just over 10 years. Now, something I wanted to confirm as well is almost a month ago, we had the poll. The last webinar of August, we had the poll, and I said to individuals, we're about to get an interest rate cut. Some people think it was going to be 25, some people think it was going to be 50 basis points. And we did a poll and we said, will the US dollar decrease in value or will the US dollar increase in value in the month of September? It's almost been a month since we've done this poll. The poll was done on the 28th of August. We're now on the 24th. So 58% voted that the US dollar will still increase in value, even though we're going to have an interest rate cut. 42% said it would decrease in value. Now, this month it has declined. So the 42% were correct. So well done to those, to that 42%. We will have a poll at the end of the webinar as well. If we're looking at the performance, at the moment, the US dollar since the start of the month has been minus 1.24% lower, but at some point it was even lower than that. So the lowest it has been this month was minus 1.78. So 42% of the individuals that voted were correct. So let's get started looking at swing trading. We're going to look at things one by one. We're going to look at swing trading. We're going to look at what kind of characteristics, what kind of methodology is swing trading. We're going to look at some examples. We're going to look at the benefits and disadvantages. And then we, of course, go to day trading. Once we've looked at both, we will look at strategies and we will look at which one may be appropriate for you. Because there are certain reasons why, based on your characteristics, the way you're trading, maybe the asset you're trading, the session you're trading, maybe because of those elements, swing trading may be more appropriate, or maybe day trading may be more appropriate. Now, what ideally I want is for individuals that are already trading, maybe they've been trading 1 month or 2 months or 3 months, so not a lot of experience. Most likely in those 3 months, because they're new traders, there's certain things they find difficult and they want to remedy these difficulties. They want a solution for these difficulties. Ideally, I want either one of these methodologies, whether it's swing or day, to be a solution for those difficulties that traders may have had in the first few months of trading. So swing trading, it focuses, ladies and gentlemen, on holding positions for several days to several weeks, capitalizing on short to medium term trends. We're going to go to the second point and then I'll explain in more simple terms. Swing trading is considered a medium term strategy. Sometimes it is known as a short-term strategy as well. Some people, they deem swing trading to differentiate to day trading, depending on whether trades are being held open for 24 hours or if they're held open for more than 24 hours. So what is swing trading? Basically, when we're looking at the market, okay, we're looking at how price movements are developing. For example, an upward trend may look something like this. A downward trend may look something like this. Sometimes for example, we saw something very similar with the NASDAQ. We saw an ascending triangle, in which case it looks something like this. It's known as ascending triangle because you can see it kind of makes a triangular pattern. This is something that we've seen lately on the NASDAQ, for example. There's lots of different patterns. These are all known as swings. So for example, here we've got an upward swing and we have a downward swing. Now, some people in the market know them as swings. Some people know them as impulse and corrective waves. We're going to look at this. The name doesn't really matter. You're not going to be a profitable trader because you know the name of something. So it's like I said yesterday, actually on the webinar, a lot of people were asking, you know, what is the default parameters for the MACD, for example? And of course, I gave the answer. Of course, I know the answer. But I tried to say to everybody, you know, knowing the default parameters, knowing the name of something, understanding certain patterns, etc., that's not going to earn you any money. That's not going to make you a successful trader. Yes, it's nice to educate yourself, to know about the financial trading market, but everybody's here in order to earn a profit. They want to be successful. They want to be consecutively successful. And things like this, it doesn't earn you any money. What we want to do is be able to learn something that I can start benefiting from straight away. So don't worry about the fact of if it's a swing, if it's an impulse wave or corrective wave. The important thing is when we are looking at swing trading, we are trying to take advantage of the swing. Okay, so it could be the impulse or corrective wave. It could be the correction after the trend. It could be the trend itself. We're going to look at this later on, and we're going to look at how we can identify. Okay, look at swing trading. This is an opportunity for swing trading. There's no point saying to yourself, this was an opportunity last week, because I see a lot of educators and they say, this was a signal last week. That's useless information to me. How is that going to help me? That was last week. The movement has already happened. You know, that's given me maybe 10% of what I should know. I want people to be able to sit there in front of their screens and say, now, this is an opportunity now, a swing trading opportunity, whether it's up or downward price movement. So swing trading, we're trying to take advantage of the swing. Swing trading is different from day trading. Day trading will either look at one or two things. A day trading will either look at trying to open and close the trade within the same session, or open and close the trade within 24 hours, ideally not past 12 o'clock. So not incurring any swap fees. Swing trading will either fall into the short-term category, short-term trading category, because they may only be opening keeping the trade open for one night. So it could be, for example, 30 hours, it could be 36 hours, maybe 2 days. To opening a trade for 1 day and 2 trades, that's not medium term. But at the same time, some people may look at certain trades which may be open for 4 days, for 5 days, for a week, maybe 2 weeks, which is considered a medium term. So swing trading may fall into short term, may fall into medium term. This is why it's known as a short to medium term strategy. We're going to look at strategies in a moment. Traders attempt to avoid swing trading over the night. This is the bullet point here, by the way, ladies and gentlemen. Traders attempt to avoid swing trading overnight where the swap fee is more expensive. People should be aware that when you keep trades open overnight, you are charged a swap fee. Now, of course, we have a swap-free trading account. We have a trading account which, for a certain period of time, you are allowed to trade without any swap fees. Of course, keep in mind though, at a certain time, that period where you're allowed to trade without any overnight fees ends. Okay. Now, I want people to also be aware, swap fees isn't something which is being charged by HFM. It is, generally speaking, within the market charge. No matter if you're traded on an exchange, on a bureau, on a different broker, an online platform, whatever it may be, if you're trading CFDs, you are charged a swap fee. It's just that for a certain period of time, HFM, and this is one of the advantages of HFM, will allow you to trade without that fee. So there's a lot of advantages also for swing trading. Now, people should be aware that if you are going to trade swing trading, you need to look at which day the swap fee is more expensive. So let's say you've opened an account, you're trading for the first time, you opened the trading account where you're not charged a swap fee, and let's say you're not charged for a month or maybe 2 months, whatever it may be. After that, it ends. Okay, fair enough, it ends. So we're trading just like we would be on any other platform. So what you need to be cautious about is the overnight fee is different for different assets, of course. And you also need to check on which day the swap fee is more expensive. The swap fee will always be 3 times more expensive on a certain day. And this is the same in the whole of the market. It's not something which has been decided by HFM. HFM will just provide you the platform, we give access for you to trade, but we of course make up we can't make up the price of the stocks. Everything is based on the financial trading markets. So we of course follow that. But for example, if we trade in an asset on Monday, the fee overnight may be $10 US. That's very, very, very expensive, by the way. But let's just say it's a round figure, is $10 US. On Tuesday, again, is $10 US. Every single day it will be the same fee, but one day a week, a lot of the time that's on a Wednesday, one day a week, it will be 3 times more expensive. So it will be $30 US, for example. Now, this is also one of the disadvantages of swing trading. When you're looking at swing trading, you always keep the trade open overnight, and you're always going to have a scenario where on certain days the swap fee is more expensive, and you have to keep in mind that swap fees, you're going to incur swap fees. So let's go now to the MT5. I want to give you an example here, ladies and gentlemen. So if I go to the NASDAQ, I right click, I go to specifications, and I go down, you can see swap rate. So you can see the swap fee 1 on a Monday, 2 on a, 1 again on a Tuesday, 1 on a Wednesday, 1 on a Thursday, 3 on a Friday. So of course you have to keep that into consideration. The market is closed the whole of the weekend, so there's no Saturday and Sunday here. So you have to take that into consideration. If you're looking to trade, hold open a trade for maybe 3 to 4 days, ideally you want to find that opportunity on the Monday, ideally on the Tuesday. So that way, yes, you still got to open on a Friday, but before 12 o'clock on a Friday, that you close that, so you do not incur that overnight fee, which is 3 times more expensive. So this is also something you need to be cautious about. Now, traders that are following swing trading, they heavily rely on technical analysis, on technical indicators. They look at this a lot of the time to identify entry and exit points. Unlike short-term trading, though, so unlike day trading, they also do look at fundamental analysis as well. So for example, interest rates were cut. They were cut a couple of days, a week ago almost. It was cut more than expected. Most people expected 25 basis points. It was cut 50 basis points. A swing trader would take that into consideration and think to themselves, the US dollar potentially has now a bias that is going to decline. So swing traders will take that into consideration. Day traders will not. Day traders, they concentrate heavily on technical analysis, maybe 95% on technical analysis. Swing traders are known to mainly concentrate on trying to take advantage of the trend. This is also a benefit, ladies and gentlemen, because of course, if you're looking at a trend, okay, let's look at, for example, here, the market is trending between this area and this area here. This isn't a trend. This is a sideways price movement. So that's not a trend. But between 1 and between 2 here, that is a trend. If you're measuring this price movement, 90% of the price movement is in favor of the trend. So this is a big advantage of swing trading because you're taking advantage of the trend. It's like, for example, if you've got a dice has 6 sides. Now, if on 4 of the sides you have the number 1, and on 2 of the sides you have the number 2, and you roll the dice, you're of course going to bet it's going to land on the number 1 because most of the sides have that number. So the odds are with you there. And the same thing applies to the benefits of trading the trend. A lot of people that say don't fight the trend, don't try and trade against the trend because you're trading against most of the price movement and you're also trading against most of the market as well. So also keep in mind. Now, swing trader, a day trader, for example, they look at those short spans of a lot of volatility. So bam, 1 hour, a lot of volatility to try and exit, enter, exit, enter, exit. So you can see here a lot of volatility. A day trader will want to enter here, exit here, enter here, exit here, and so on and so forth. Then it loses volatility, then we get more volatility here. Day traders that want to enter, exit, enter, exit, enter, exit, and so on and so forth. A swing trader, ladies and gentlemen, they're happily to stay calm, easy, look at the markets, identify the trend, and will happily keep it open for longer. They allow volatility, so they may look to, for example, take advantage of here, exiting here, or take advantage of that entry point and have a longer term trade all the way down to here. Then they may look to trade in the opposite direction, so they may look to trade up to here. So that's, for example, ladies and gentlemen, that is 4 days. They may look to take advantage all the way up to here. That is almost 6 days. So you can see here, this is classic swing trading. Now, I've not showed you yet how to swing trade. We're going to look at a strategy in a moment, but I'm just showing you on the chart what kind of price movement swing traders aim for. And you can see we're trying to trade the trend, and we're trying to take advantage of the swing. So this here, ladies and gentlemen, is the swing. This is the corrective wave here, ladies and gentlemen. People can also look at it slightly more short term. So they may say, this is the impulse wave, the swing, this is the corrective wave, and then this is the next swing, and so on and so forth. So that's also something you can take into consideration. Now, what else can you look at in order to try and identify where there's opportunity for swing trading? Now, some people may look at the breakout, okay? So if you look at the downward trend, basically what you're doing is saying, you're trying to identify the swing low. So you can see this is the downward swing. The swing low is here. So basically what they say is, if it drops below this level, this is a breakout level, I may try to take advantage. I will see that as a signal to speculate in favor of the continuation of the trend. Now, there are slight disadvantages to this to swing trading. Why? Because swing trading is slightly longer term. It's not necessarily ultra short term. Breakouts, a very big thing with day trading, a very big thing with scalpers. That's of course understandable. Swing trading, if you're looking at this impulse wave, if you measure between here and here, if you're going to trade at the breakout, so this is the breakout here, you've missed half of the price movement. So there's disadvantages to using breakouts. Nonetheless, you can use breakouts as well. Now, something else which I also I'm going to look at today is you can use a mixture of a swing trade and day trading as well. This is also something you can look at. We're going to explain this later on in the webinar though. Now, so this is the breakouts. Another breakout is, for example, here. This is the swing high. So basically at the point it starts to retrace and it's at the high it has been. And then as soon as it breaks above that, so it breaks above it here, then you speculate again the upward price movement. If you don't want to do that, you can look at the Fibonacci levels. Okay, so what do you do if you're looking at the Fibonacci levels? You basically draw Fibonacci retracements between the high and the low, and it will give you a 63 level. The 63 levels approximately will be, for example, somewhere here. So this is another thing you can look at. Basically, instead of trading the breakout here, you can instead trade earlier and try and take advantage of a larger portion of the trend. So these are the Fibonacci levels. You also can use moving averages. There's different ways you can look at moving averages. You can use them as trend lines. You can use them as crossovers. You can see I've got crossovers here, and you can also look at pivot points as well. Now, I'm going to go to the MT5 very quickly, and I'm going to give you some examples of these when looking at time frames such as swing trading. A very, everybody, when they think of swing trading, they tend to say the 4-hour time frame. However, some people, though, a lot of the time, they can say the 3-hour time frame, and you can look at other time frames, of course, as well. People can look at a mixture of different time frames. So somebody look at a breakout. They may look at this area here. So for example, this is at this blue line here, ladies and gentlemen. Let's change the color actually, because I think that blue line isn't very I can see some questions as well. Bear with me, ladies and gentlemen. By the looks of it, my MT4 has frozen. I don't know why. Let's look at it again. There we go. So, ladies and gentlemen, here we can see we've got an area that we've got a crossover. So you can see here it's an upward crossover. Let's change the color. Let's make it yellow, maybe. There we go. So hopefully now it's more visible. So you can see here the moving average, it crosses above. Okay, this is indicating upward price movement. If it crosses below, it indicates downward price movement. Now, it doesn't necessarily mean every time there's a crossover, it's going to move in that direction, but it's something we can take into consideration. Now, we also can use pivot points. So I know that a lot of people here are going to start purchasing, but I know there's a possibility a lot of large institutions, they may actually say to themselves, a lot of people, they're going to be buying here, putting their stop losses here. So they may drive the price down to take advantage of those stop losses, and then they get a bigger swing upwards. So people can say, that's a crossover. We're going to take advantage of this crossover here. But a lot of people are going to be putting their stop losses at this blue line. So we're also going to take into consideration opening a second buy at the lower blue line as well. Swing trading, we've got we keep our stop losses and take profits further away. That's also something for us to take into consideration. It has to be something you're willing to do. Either way, you can see we're getting a lot of upward price movement. Now, if we're not going to look at crossovers, and like I said, we're going to look at breakouts and Fibonacci levels, what can we look at? So here, for example, here we're looking at the USA 100, so basically the NASDAQ. You can see we've got a swing here. That swing loses momentum and it declines all the way back down to here. So there's two things I can look at. I can look at the breakout. This is the breakout here. So basically, if it crosses above that, I'm going to buy. Now, doesn't mean it crossed above it and I'm going to buy somewhere up here. It crossed above here. That's where I'm going to buy. If I missed it, I missed it. I can't take advantage of it again. We can look at the breakout. Alternatively, what we can do is we can draw, like I said, Fibonacci between the low and the high. So this is the low and the high of the retracement. And instead of buying high there, we can buy at the 61 level here or the 65 level here. So we're entering at a lower level, a better entry point. So this is also something we can take into consideration. So let's move on. I've got some questions here. How do you change Fibonacci from 61 to 63? Some of these also I can see here said, how do I add 65? It's very simple. If you look at Fibonacci levels, I'll just draw randomly here, Fibonacci levels here, and you can see there's a red line here. If you right click on the red line and click properties, it brings you up with this, and then you've got levels. So you can see all the levels here, ladies and gentlemen, and you can add any level you want, to be honest with you. For example, I added the level at 65. You may not wish it to be at 65. Maybe you want it to be 0. For example, somebody says 63. So let's add 63, 0.63. And here again, I'm going to change that to 63. There we go. So it's not going to be 65. You can see now it's changed to 63. So that's how you change on the Fibonacci. We're going to look at that in more detail, of course. Now, day trading. Day trading involves buying and selling financial instruments in the same day. Now, some people, they look at day trading. Some people, they look at session trading. Both technically is day trading. Both fall under short-term trading. It cannot be looked at as medium-term. It is strictly short-term trading. You cannot keep trades open overnight. Some people will not even keep the trade open outside of a certain session or certain hours. So professional traders, a lot of the time, they say, I trade one asset For example, a lot of people say they trade something very popular with professionals is they trade the pound against the Japanese yen. Very, very popular with professional CFD traders because there's a lot of volatility there, very clear price movements that get a lot of clear pivot levels, a lot of clear areas where a lot of people put their stop losses that they try and take advantage of. It's very, very popular by us professional traders. And a lot of the time, traders, they will trade between 9 o'clock to 12 o'clock. That's it, 9 o'clock to 12 o'clock UK time, they trade nothing else. So that's really session trading, it's not even day trading. So keep in mind, day trading, session trading, very similar. Day traders, yes, they take into consideration the news, for sure, but they don't take into consideration fundamental analysis. News trading is not fundamental analysis. Maybe it's 1% of fundamental analysis, but it's not fundamental analysis. It's very weak fundamental analysis, if it is at all. Day traders, swing and session traders rely solely on, almost solely on technical analysis. Day traders rely on high volatility. They like high volatility. Of course, beginners, they prefer high volatility but clear trends, so clear one direction price movements, and they want to see clear impulse waves, corrective waves, impulse wave, corrective waves. A lot of people that say, you know, what should I trade? Because on a lot of webinars we say there's advantages for beginners to trade in one asset. It's up to you how many assets you trade. You can trade 1,000 different assets, but each asset is very different. So you're going to learn faster and learn better, and your knowledge is going to be a lot more vast if you're trading one asset compared if you're trading 10 different assets. So a lot of people say to me, okay, I understand the advantages of only trading one asset, but what assets should I trade? There's simple things to look at. We ideally want the lowest spread, the lowest overnight fee, so the swap fee, but also we want clear price movement. If it's up, then up, down, up, down, up, down, down, up, down, up, down, up, down, up, and so on and so forth. For beginners, it can be quite difficult to trade. I can see some people here that I've spoken to a lot of the time, quite a lot of times. I can see they've been trading, a few people here, and a lady as well, who I can see here that we've done one-on-one sessions on a lot of time, a lot of occasions. A lot of these people have been trading 9 months. I think that lady, I won't say names, I say lady, I'm not being rude, I don't want to expose sensitive information. She's been trading at least a year minimum. They don't mind up and down scenarios, but beginners, there's advantages when you can see clear up, retracement, up, retracement, up, retracement. It's a lot easier to trade. So keep that in mind. So both use technical analysis, but swing traders and day traders, they use technical analysis, but they use them in different ways. Let's continue because I want to get to the strategies as quickly as possible. This is an example of day trading. Now, day traders, they use swing trading, they use breakouts more than swing traders. Why? Because yes, for example, here they've missed all of this price movement, but they don't care really because they're entering here, they're going to exit here. It's not a big issue. They've got that one trade, maybe 2 trades maximum. They're in, they're out, they've taken advantage of it, they've profited it. It's not a big issue for them. Whereas swing traders, that's not enough for them. So they're going to earn a little bit, but then the market will move against them and they'll close the trade in a loss. That's not something they want to see. So benefits of day trading, since we're now speaking about day trading, then we'll look at benefits of swing trading. So a big benefit is overnight fees. Never should you be charged an overnight fee. I say there's exceptions, there is always exceptions, when we looked at a couple of weeks ago, we created the trading plan together, and we said there's a 10% exception rule. So you're opening 10 trades a week, for example, you can have an exception on that one trade, not on 2, not on 3, not on 9 of the 10 trades. Otherwise, it just becomes irresponsible trading. You can have an exception. So if a trade is at a break even, is at a slight loss, for example, it's not hit your take profit, but your certainty is the next day, then of course you can take into consideration keeping it open as an exemption, and you are charged an overnight fee. If it's on the day you're charged 3 times more expensive, do you really want to keep it open? That's down to you. But big benefit, no overnight fees. You don't have to worry about overnight fees. Another benefit is day traders, they're more active. Now, people, a lot of the time, people, they want to be active. There's either people that would prefer not to do anything at all, and they want to trade as a minimum as possible, in which case swing trading is a big benefit for them. But there's also a lot of traders that say to me, you know, swing trading is boring. I want to sit there, I want to trade, I want to learn, I want to earn. You know, that's day trading, guys. So there's that benefit. Another benefit is quick exits. If the market moves against you, it's not a problem if you're a day trader. Exit, trade in the opposite direction. It's not, if you get it wrong, exit and trade in the opposite direction. Swing trading, you can do that, but you allow the market a lot more time and you incur a much higher loss. Of course, you incur much higher profits as well. So the reward to risk ratio is very important here, but it's not quick trading. It's not, if you're swing trading, you cannot be swing trading. And for example, you've got a trade like this, and you're opening here, your stop loss is here, okay? But your take profit is all the way up here. You're definitely going to hit your stop loss. You haven't allowed enough volatility, enough space, enough time in the market for your trade. So you don't have the benefit of quick exits and an alternative trade. With day trading, you have that. You have that. So that's a big benefit as well. It could be a benefit also, which that also can be a benefit for swing trading. I'll explain that on the next slide though. Traders that are day traders, they do not trade more than one asset most of the time. At least most experts and financial advisors and professional traders, they advise individuals to, especially who don't have a lot of experience, to stick to that one asset. If you're trading one asset, it doesn't mean you earn less. It doesn't mean you trade less. You may trade 10 assets. I'm trading one asset. I may trade 10 times more than you though, even though I'm trading just that one asset. So don't mix, you know, more assets, more profits. That's 100% not accurate. Day traders are also able to switch off. For example, I do day trading, but I also do swing trading as well. But I love the fact that with day trading, you know, I can say to myself, I trade the GBP, JPY, I trade at 9 o'clock, I stop trading at 12 o'clock, and I switch off. That's me done for the day. I've opened my 10 trades that I allow on my trading strategy, on my trading plan. I've done that. I've hit my targets. I've exited. That's it. I'm going on holiday for the rest of the day. I don't go on holiday for the rest of the day. Of course, I work full time, but I just want to give you an example. It has that benefit. Now, disadvantage. Timing with day trading is vital. Timing with day trading is vital. It's not like swing trading. Swing trading, timing isn't massively important because, you know, you're seeing a trend like this, all right? For example, here, you're entering the market here. This is where you buy, okay? Your stop loss is somewhere down here. Your take profit is, for example, somewhere up here, your take profit. The market does this, okay? Terrible drawing, but I'm using a computer mouse, so please forgive me. The market does that. For day trade, that's really difficult to trade. There's no clear trend there. We're kind of moving sideways here. then it does eventually form into a trend. But if you were day trading and you were buying here, it probably would have hit your stop loss because the market moved against you, then it moved in your favor, then against you, then in your favor again. If you were day trading, it would have hit your stop loss 2-3 times. Swing trading, my stop loss is very far away. I don't care. I just let the market do its thing. As long as it's going to hit my take profit at the end of 3-4 days, I'm happy. So timing is less important with swing trading. It's not the same with day trading. So if you fall into that category where you analyze the market, your analysis is amazing. Okay, a lot of people say this to me: analyze the market, my analysis is amazing. I can say that this week this asset is going to increase in value, and it does increase in value, but my timing is terrible and my success rate is at 50%, not because I don't know how the market is going to move, but because I cannot determine when is the right time to enter and exit. So that's a very good scenario where actually day trading may not be advantageous to you, but maybe swing trading will. So timing can be an issue. Volatility can be an issue. This isn't a disadvantage here, but this is something very important. The reward to risk ratio. You have to look at your success rate. You have to look at your reward to risk ratio. You don't have that benefit of saying, I'm going to put my stop loss 50 pips away. That's very far away. Day trading, you want to enter quickly, exit quickly. You're most likely aiming for a high reward to risk ratio. So the ratio is high, but actually in terms of how close the stop loss is, the stop loss is quite close. The take profit is quite close as well. So you need to be strict with your stop loss and take profit and your reward to risk ratio. Don't forget, guys, it's not important if you've got a positive reward to risk ratio, if it's negative. What's important is based on your success rate and the number of trades that you are opening, your reward to risk ratio is appropriate. So I could have a reward to risk ratio that's negative. I could be risking $30 per trade to earn $10 per trade. So the reward to risk ratio is 3-to-1. It's negative. But if my success rate is 95%, then I don't care. That's not an issue for me. That is negative. I allow the market a lot of space. It's increased my success rate. I've got a 95% success rate. And at the end of each week, I'm profitable as long as I have that success rate. The success rate changes, then of course, it depends how much is changing. But you can see the reward to risk ratio is not about it being positive. It's not about it being negative. It's about the reward to risk ratio being in line with your success rate. Something very important, lowest spread possible. The lowest spread possible. If you want to trade currencies, try and have the lowest spread possible. The lowest tends to be the Euro USD, but try, if you don't want that currency pair, that's absolutely fine. But don't go to exotic and extremely expensive, etc. Don't keep things open overnight unless you have to. Try and trade the same assets, always the same time, every single day. Also, ideally for day trading, try to have a like-to-like reward to risk ratio. You don't have to, but try to have a like-to-like. I've got some more questions. I will answer these questions. Somebody here says, if day trading, what kind of returns are you looking for, as price movements can be very low, sometimes under 1%? I'll show you something which can be very helpful in regards to this. It's about, because it's different for every asset, has different volatility levels. So I cannot say you should be aiming for 10 pips and that's it. I cannot say that. Every asset is very different. I will show you how you can confirm the answer to that in a moment. I've got another question. Somebody's asked something about the registration. It's not related to today's topic. Thank you for letting me know. I'm going to save that. I will reply to you personally because it's something about the website. And I'll make sure the relevant team is aware. So thank you for that. Very quickly, let's go to our MT5. Let's look at a different asset because I just mentioned the Euro USD has the lowest spread possible. Currently, it's only at 1.5 pips, for example. Let's go to a 15-minute time frame, like so. Let's zoom out. What do a lot of people do? Okay, a lot of people, let's zoom out a little bit more. They will measure all of the price movement on the asset. So they'll basically say, you know, this price movement here is, if you look at this price movement all the way down to here, 0.75. This price movement, 0.37. This price movement, I'm looking at all the downward price movement, 0.27. This downward price movement, 0.18, and I keep doing so. And what I do is I add them all up and I create the average. So on average, this is the type of price movement that we see with the asset. Now, if I'm trading in favor of the trend, I know that on average, this is the size of the price movement we tend to see. So how far? So for example, you know, if we're going to see downward price movement, let's just say, for example, on average, the downward price movement declines all the way up to here. This is on average. Now, I'm going to trade, you know, my signal, let's say, is here. So I know this is where I'm selling. This is where I'm going to close my set. This is where, on average, the price movement loses momentum. So that's, for example, 0.19. I may say to myself, I'll aim for half of that just to be safe. So 0.19, instead I'll look at 0.09 or 0.010, one of the two. You may say I'll try and earn 60% of that. So that's 0.11, I think. So that's something you can look at. There's no such thing as strict, I should be aiming for this amount. Every asset's very different. What's important that you know and understand the traditional characteristics of the asset. And believe me, as you keep on measuring, every single time there's upward price movement, you measure. Every single time there's downward price movement, you measure. So you know, we've seen this upward price movement. I know now it's oversold. So I know that we've got a lot of upward price movement. Right about now, people will start selling. I know if we're going to see a small retracement, the smallest retracement we see is here. The largest retracement we see is here. On average, we see retracements here. So I know that potentially, if we're going to, on average, the price movement will decline to here. I'm not going to risk that, and I'll say, I'm going to look at 75% of that. So I'm going to look at, it may decline to here. So if I want to speculate against the trend, I'm speculating a decline, I'll put my take profit here, for example. At the same time, when it starts to move upwards again, I know the smallest impulse wave we see is here, the largest we see is here, the average we tend to see is here. So again, as it starts to increase and I speculate a buy, I will look at, for example, a take profit here. I may want to lower my risk appetite and say to myself, I'll look at 75% of that and I'll exit, for example, somewhere here. So hopefully that makes sense as well. Now, benefits of swing trading. As I've already said, the timing is less important. It's still important, but it's less important. Traders are known to have the ability to trade 2 or 3 assets. A lot of swing traders, though, still choose to only trade 1 asset, but it's more commonly known that they trade 2 or 3. Whereas with day traders, if you're looking at professionals, most of the time they don't trade more than 1. Whereas swing trading, it is quite common. It is quite common. I wouldn't say that's something uncommon. Trade management is easier because they're slightly longer term. You have less trades open. It's easier trade management, but at the same time, timing is still very key. Less time in front of the screen, you may say, I'm going to open one trade today. I analyze the market. I've got one trade and one alternative trade. As soon as that's triggered, I close the computer, keep an eye on it through my phone. That's it, done for the day, for example. So less time there required on your screen. Something else which is also very important. A lot of beginners find analysis easier when swing trading rather than analysis with day trading. That doesn't mean swing trading is easier, but the analysis to be able to determine price movements in the medium term sometimes are known to be more easy. So basically easier. Disadvantages: if you're going to keep trades open for 2, 3, 4 days, most likely you will incur some news that may change the scenario in the market. You definitely will incur overnight fees. Still, again, reward to risk ratio needs to be very important. Must be able to keep your calm as well. The trade's going to be open for 2, 3 days, maybe more, depending on how what kind of swing trading trader you are. You have to be able to keep your cool. Whereas with day trading, you open a trade, half an hour, you're going to close it. You only have to keep your cool for 30 minutes. With swing trading, it may be 30 hours, it may be more than that. So you have to, of course, keep that in mind. Now, we of course want the lowest spread as well possible. Like we said with day trading, it's less important though. What's more important is we want the lowest swap. We want to try and avoid weekend risk. This is something very well known. You can Google it and research it. Weekend risk. We actually had the webinar last year where it was a full webinar explaining weekend risk. Ideally, if you're swing trading, we want a positive reward to risk ratio. It's not like day trading where we can take into consideration if you've got a high success rate, maybe we look at a slightly negative reward to risk ratio. At swing trading, ideally people want a positive reward to risk ratio. And if you're going to trade more than one asset, you definitely don't want them to be correlated. For example, you don't want to be trading a buy on the USD JPY and a sell on the Euro USD. It's correlated, there's no point. So swing trading strategy 1, we're going to go through I've tried to have the simplest possible swing trading and day trading strategies, as simple as possible. Now, something I want people to think about though, and I always think about this, put my entries where the mass, so where most people will put their stop losses. I always think to myself, where are people putting their stop loss? Because that is something very key. Where are people putting their stop loss? This is something I would say beginners. So I've got a question here. How do you determine the best reward to risk ratio for swing trading? How do you determine it? You need to look at different scenarios. Let's go back a page. So if I open, let's say, for example, you already have traded, let's say for a couple of weeks. You need to say, how many trades do you open? Okay, this is something you need to say to yourself. How many trades do you open? If you open, for example, 10 trades per week, okay, how many are successful? So how many do you close in a profit? If you close 6 in a profit, then basically that's 60%. 60% success rate. 6 trades are in a profit, 6 trades are in a loss. You need to go back and look at all of those trades and say to yourself, here I was successful. How long, on those occasions that I was correct, how long could I have kept open those trades for? And the ones which were inaccurate, where would it have been beneficial for my stop loss to have been? So you're going to do this, okay? And you're going to say, okay, you're going to identify where you would have exited, and you're going to say 4 trades were in a loss, 6 trades were in a profit. If you identified, those 6 trades is $50 take profit, and those trades that it was stop loss, again, you were looking at $50. So you would have had basically a turnover of $300, and basically losing trades, basically expenses of $200 US. So you're in a profit of $100 US. So you can see this is profitable. But if, for example, you're going to say, my stop loss is going to be at 150 and my take profit is going to be at 50, then 4 times 150, that is 400, 600. So 600 is your expense, and then 300 is your profit. So you're in a minus of 300. So you know your reward to risk ratio is wrong. So you need to look at your trades, look at what you're trading, what your success rate is, and then identify what reward to risk ratio you need in order to be profitable. Because you may have a terrible success rate. I know I spoke to somebody on Friday. He had a terrible success rate. It was actually really bad. It was at something like 20%. So he was opening, I think it was 20 trades per week, and his success rate was 20 something, but let's say 20% anyway. So basically, he had 4 trades in a profit per week, and he had 16 trades in a loss per week. Now, he definitely needs to try and improve his success rate. But in the meantime, he wants as high a success rate, he wants the highest reward to risk ratio as possible. So at least he's close to a break even, if not at a break even. So he may say to himself, per trade that I'm in a profit, I will aim for 50. Per trade that loses, I will aim for the stop loss to be at 10. So I've got expenses at the end of the week of 160, and 4 times 50 again is 200. So even though my success rate is terrible, it's at 20%, I'm still in a profit of $40 US. So you can see here how I'm going. I can't sit here and explain it in a lot of detail because today's webinar is not based on the reward to risk ratio. But this is how you look at it. You need to be realistic with yourself and base it on statistics. You need to say, this is my success rate. This is how many trades are opening. These are how many are closing a profit, how many are closing a loss normally. If every week is different, you need to look at the average or the lowest you tend to see. And you need to say, this is the reward to risk ratio I need to be profitable. So something you need to say, where will people put their stop losses? Now, this is a swing trading strategy. It's 30 minutes. It's kind of the shorter version of swing trading strategy. Still, swing trading is not day trading. People basically, they'll say if the price here is above the 250 simple moving average, this is a 250 simple moving average, you will only look at areas to buy. You won't look at areas to sell. Simultaneously, you want the RSI here, the blue line on the RSI, to be between 50 and 75. So for example, here it's between, so basically here it's between 50 and 25, but you want opportunities to buy. So that's an area which is saying don't trade, don't look at opportunities to buy, wait. Whereas, for example, here, this area of the market is saying try and find opportunities to buy because we're between 50 and 75 and we're above the 250 simple moving average. Simultaneously, you can look at when it crosses over upwards. So you can see the moving average crossed over upwards here, crossed over upwards here, crossed over upwards here, again crossed over upwards, crossed over upwards, crossed over upwards. So you can look at all of these areas. The next thing you can look at is, of course, breakouts. So you can see this is a breakout area, this is a breakout area, this is a breakout area. If you see large retracements, you can look at Fibonacci as well. But you need to say, where are most people putting their stop losses? This here area is where most people are putting their stop losses. So these are areas where you need to say, if it goes to that area, I really now need to take into consideration, are people putting their stop losses here? If you've got more advanced traders using more advanced tools, if you're at these areas, look at the volume profile, look at the VWAP, also look at the DOM as well, the depth of market. So you can look at all of these things and you can see multiple areas where you would have bought. You would have bought here, for example. This is an area you would have bought. You could have bought here, here, and here as well. A lot of people would have been buying in this area because you got an upward crossover. A lot of people again would have bought in this area because you got an upward crossover as well. Here we had a breakout. A lot of people would have been buying here also. So these are all areas where you can see I'm putting buys. Okay, stop loss and take profit. Like I said, we're measuring all of these price movements and looking at that to determine where potentially we're going to put our stop loss and take profit, because we're looking at the average price movement. And we need to say to ourselves, you know, if people are putting their stop losses in these areas, maybe I want to put it somewhere just below the 250 moving average, or maybe if people are putting their stop loss here, I may want to put it slightly lower, for example, in these areas. It depends how far we are from the moving average. So this is something for us to look at. This is a downward price movement now, so completely, completely different type of price movement. Let's exit this. Let's reopen this. There we go. So different type of price movement. We can look at this again. This is a downward price movement, swing trading, same scenario. Areas here where people really want to look at buy opportunities. Now, when we look at these areas here, for example, in this circle, people don't want to be looking at buy opportunities. It's just about below the 250. So you need to be cautious about speculating a decline. Areas down here, though, you may want to look at opportunities if we're getting downward crossovers. But this is another scenario where, again, especially in this area here, you can be looking at crossovers, downward crossover, downward crossover, downward crossover, downward crossover. There's going to be certain trades that you will see a loss. Of course, it's not an issue as long as you're incorporating it into your reward to risk ratio. That's the main thing. But we're looking at the crossover, we're looking at the moving average, we're looking at the RSI as well, and we're looking at this to determine how the market, where we're going to enter our sells and enter our buys. Let's look at swing trading. Swing trading, we can look at again. We can look at a scenario where it's known as the regression channel. Here we've got a 100 bar simple moving average. This time we're on a 15-minute time frame, much smaller time frame. Basically, what we're doing is we've got here, I've got actually a chart where I'll give you these moving averages. So you can see here, the yellow is gold. Sorry, the yellow is a 13-day exponential moving average. Green is a 43-day. The red is a 63 period, and the blue is a 100 period. So you can see basically forms a bracket. Now we want the brackets to be widened. We don't want them to be crossing over each other. So if we're above the blue, we're looking at opportunities to buy. If we're below the blue, we're looking at opportunities to sell. Now, if the price moves back into and below the yellow, so if it's between the yellow and the green, we could see a strong buy signal. If it's between the green and the red, we could see a weaker buy signal. If it drops below the red, we see no signal at all, so we don't take it into consideration. So hopefully that makes sense. Quite simple. Let's get rid of these. Now, the next thing, ladies and gentlemen, is as soon as it declines, we're going to count back 4. So you can see it declines here. So we've gone into that bracket between the yellow and the green. We're going to count back 4. So 1, 2, 3, 4. 4 candlesticks. And we're going to draw a red line at the highest levels of those 4 candlesticks. The highest level may not be the swing high. Sometimes it is, sometimes it's not. So we're going to look at that. We draw a red line there. As the price increases in value and it breaks above this red line, that's where we open our buy signal. Let's look at it again. We decline, we go back into this area and we draw 4 candlesticks back. Okay, 4 candlesticks back. So we go 1, 2, 3, 4. 1, 2, 3, 4. This is where it loses momentum, so this is where it starts turning green. So we count back 4 candlesticks. This entry is slightly wrong. It should be slightly higher. It should be about here. So again, we draw our red line there, and as the price, like it does here, breaks above it, then we speculate the continuation of the trend. It happens again, declines back into that bracket. We count back 4 candlesticks. 1, 2, 3, 4. Okay, breakout level. We can see broke out here, and again we start to trade again the continuation of the upward trend. So you can see here how I'm using this to speculate upward price movement. Now this is the Dow Jones, a completely different asset, 5-minute time frame. We're going to do the exact same thing, guys. So for example, we can see we dropped below here. So I go back 1, 2, 3, 4. The current high is the area, the current candlestick has the highest level. So we draw a red line there. Crossed above, happy days, we trade the buy. We drop below again. So we do 1, 2, 3, 4. The highest level is here. As it crosses above there, we again speculate the buy. Then it drops here. 1, 2, 3, 4. This is the breakout level. Now this breakout level, kind of 50-50, depends how close we put our stop loss and take profit. It rarely goes into a loss. The highest that we saw was all the way up here. So it depends how close we put in our take profit. The first buy though, ladies and gentlemen, was here, so much higher as well. Those two are definitely in a profit. The third one is kind of 50-50 because it goes up, goes down, goes up, goes down, and we don't know today if it continued to go up or down. So this is another example as well for swing trading. Now, last thing we're going to say, which is the most appropriate for you. You need to look at, now that you understand the characteristics of day trading and swing trading, you need to look at your characteristics. Do you want to trade a lot? Do you not want to trade a lot? Do you want to trade only specific hours? Are you happy for trades to be kept open overnight? What issues do you have? Are your issues the analysis? In the medium term, you cannot identify the opportunities in the market? Or is your analysis for the medium term amazing, but your timing in the short term isn't great? We, of course, need to look at this. Are you already trading? You need to look at what you're struggling with, because which of the two is going to help you? For example, if the timing is the issue and volatility is the issue, maybe it's swing trading which is better for you potentially. If that's not the issue, if the issue is more, you incur overnight fees, you keep trades open for too long, you allow the market to move against you for too long, things like this, maybe more day trading, which is a lot stricter, quicker exits, is a better scenario for you. So you need to look at this. This is the main thing that you will look at, which will help you determine whether you should be looking at day trading or you should be looking at swing trading. You need to, because we've looked at today, what is providing a remedy? What is providing a remedy for you? Is swing trading going to provide a remedy for you, or is day trading going to provide a remedy for you? I just released a poll, ladies and gentlemen. If people can answer, I want at least 60% of people watching today's webinar to answer. I'll allow people a few more seconds. I can see 30%, 33% now have answered. I want it to go to 60. Can see it's going up very quick. Very, very interesting. I will confirm to you if people prefer day trading or swing trading. I will confirm to you. People have questions, feel free to ask, and I will answer all questions. I want at least 60% of people to answer the poll. 10 more seconds only. 10 more seconds only. 5, 4, 3, 2, 1. So just over 60% of people voted. I will confirm what people voted as well. I'll share it with you now so everybody is able to see it on their screen. 44% preferred swing trading, 56% preferred day trading. Now let's look at answering the questions. Somebody says, if you can explain where to put stop losses on day trading. Yes, of course. There's different scenarios as well. Keep that in mind. Let's go back to our MT5. People look at different things. People, for example, this is a 15-minute time frame. Like I said, some people look at Fibonacci like this, okay? As it retraces, they put the Fibonacci retracements. As it regains momentum, for example, at 63, somebody said, which is basically here at this blue line. As it increases up again, they'll speculate a buy. They'll put their stop loss just below the Fibonacci levels like this, okay? This is one example where people put their stop losses. Another example is people have a larger moving average. So for example, here there's a 100 bar simple moving average, and people will put their stop loss. People will put their stop loss basically just below the moving average. So if somebody's buying here, they'll put their stop loss here, for example. This is another scenario. There's different scenarios people look at. We also have a webinar on YouTube that I did, I think 3 weeks ago only, about where to put potentially your stop loss and take profit. Now I'll answer the rest of the questions. I answered that one. Will you confirm where to put stop loss on day trading? Yes, we just looked at that. So somebody here says you're using different moving averages, depending on if you're swing trading and sometimes on different webinars. I always look, it's always different. And if the market condition changes, I again change the moving averages. This is something, to be honest, you learn with experience. But what you do is you keep changing the moving averages based on the price conditions that you're seeing. For example, if it was at 75, it's not working very well for you, you may change it to 50. You may change it to 45. You may decide to increase it to 80, to 85. You keep testing to see, based on what you're seeing, what gives you the most accurate one. Okay, so this is not something strict that this is the moving average you're going to use. You will never change it. You always will keep changing it depending on what you're trading and the market condition. How to see the swap fee per day? Yes, you can do that on the MT5. So here's the MT5. If you right click on an asset, you go to specifications, you go down, you can see swap fees. So for example, here, the swap fee is 3 times more expensive on a Wednesday. With the NASDAQ, we saw it was on a Friday. Somebody says, my timing is great, but my entry is the issue. What is the issue with the entry? You need to specify if you want me to be able to assist. If your timing is great, maybe day trading is better, okay? Because if the issue is the direction but your timing is great, maybe day trading is better, because if it moves against you, you can quickly exit and amend to take advantage of the trend. Someone here says, how long before the webinar is available on the HFM site? By the end of the week, it's available on YouTube, and normally you get an email. You only get an email if you If you attend the webinar, if you don't attend the webinar, you don't get the email. Is YouTube's videos under your personal name or HFM? No, it's under HFM. So type in HFM and you'll be able to get access to it. Do you apply the same strategy to daily and 4 hour? Depends. You need to test it on time frames. So again, it's not strict that, you know, these are the moving averages, it's on these time frames. You need to go on the time frames and test it. So for example, you know, if I'm on a 5-minute time frame and I'm using these moving averages, I need to test see how accurate they are. So if I'm looking at this moving average, I can actually see the 100 is working very well. Look at today. We've been consistently more or less above the moving average. Sometimes it reaches it, sometimes it's just below it, but the moving average is doing quite well. So you can see I'm testing it. I'm not strict on it, because if I change the asset, these moving averages may not work. If I change the time frame, again, these moving averages may not work. For example, again, this crossover is very well, does very well. This crossover does very well as well. I can see crossovers are doing very well. This crossover does very well. So you can see I'm testing it. So again, if I change time frames, I need to retest it because it may not do so well. For example, on the 15-minute time frame, this is where I get the signal. It's an upward signal, but it declines for the next hour and 15 minutes. So on that time frame, it isn't great. Somebody here has asked a very technical question. He says he's making some profits. He wants to be able to navigate his technical analysis more. It's a big subject. It's not something I can answer just in 30 seconds. That individual, there's a lot of things that he can do. A lot of things he can do. The best thing to do is request a one-on-one session with me. If he speaks to his account manager and say, look, I want a one-on-one session with Michalis. Even if, you know, he's, because there's a lot of people that request sessions with me. Even if he says to you, look, he's very busy, XYZ, say, you know, it's not a problem. Book me the time, I'll be patient, and we can look at this together, guys. Especially with something technical like that, because that's something I need to look at more one-on-one. It's not something I can answer just in 30 seconds. Somebody says he opens based on technical analysis. After 1 hour is profitable, but he panics because it goes into a minus straight away. Then maybe better to look at swing trading, where you open, you put your stop loss and take profit, and you forget about it. You're not there like a day trader standing in front of the screen thinking to yourself, is it a profit, a minus, is it a profit, is it a minus? You can sit back, you know it's going to be open for 24 hours, and you just let the market do its thing. So I've answered a lot of questions. I can see a lot of more questions though. Some of the more advanced questions, which is something I cannot answer in 30 seconds. I haven't answered them. I'm not ignoring you. It's better to either send me an email, in which case I can show you step by step, write you down an email with a lot of information, because I don't want to bore everybody else. And I can confirm to you what different things you can take into consideration, or we can look at a one-on-one session. So guys, let's end today's webinar. It was an enjoyable webinar. Hopefully people found it educational. In the meantime, trade safe, trade responsibly, and we'll speak again on our next webinar. In the meantime though, goodbye.